Okay. So today's lesson is taxation of mining companies, right? So mining companies, taxation of mining companies. That's what I want to look at today. It's a short and sweet topic, so you just have to make sure you pay attention. All right. So introduction. So mining rights, or rather mining rights that can be granted, the basically to the two mining rights that can be granted to an individual who wants to start a mining company. So one, there's exploration license, then there's mining license. So exploration license is where you just go and look around. You check in Zambia, you use your equipment, you look for minerals. Then mining license is the actual act of digging the minerals from Earth's thrust, right? Then the non-mining rights that can be granted are the three. There's the mineral processing license, then there's the mineral trading permit, then the mineral export license. So one, mineral processing, you get the copper ore, you process it into the copper cathodes. It needs a license for processing. Then trading, selling the minerals. If maybe you're a small scale miner, you just mine the copper ore, then your customer is KCM, you need a trading permit. Then mineral export, so KCM for it to sell um, copper on the London Metal Exchange, it needs a metal export license. So those big companies that explore as well as mine and trade and process, they have to get all these licenses. Right, then let's look at mineral royalty. So mineral royalty tax. This is basically tax which is paid by a person in possession of minerals. So you, Mr. Isaac, if you find yourself in possession of minerals, you are supposed to pay mineral royalty tax, right? So for the most part in taxation, mineral royalty covers copper, right? Copper is it's the most important mineral in Zambia that we have. So mineral royalty is largely paid on copper, right? So the following are the mineral royalty rates. So you don't really need to memorize this. You just need to understand how to apply them, because in the exam you'll be given that formula sheet, right? At the first page, maybe the first two pages. So you just have to know uh, how this operates. So when you're calculating mineral royalty, the the mineral royalty rate is charged on the norm value, right? So now there are certain ranges that you're supposed to apply. So there's there's this one, right? 5%. So if the norm value is between if the norm value, right, or norm price of copper is less than 4,500 per ton, right? So at the metal exchange, copper is quoted per ton. So now if the norm value, we're going to look at the norm value, I think, in the next slide. So if the norm value is less than 4,500 per ton, then means the mineral royalty that's supposed to be paid is 5% of that norm value, right? Then if the norm price is between 4,500 but less than 600,000. So it's more than 4,000, it's 4,500 or more but less than 6,000 per ton, which is 6,000 US dollars per ton. The mineral royalty rate that's charged on the norm value is 6.5%. Right? And here again, the same thing applies. If it's 6,000 or more, but less than 7,500 US dollars per ton, the norm price, then the mineral royalty rate is charged on the norm value at 7.5%. The same thing applies if the norm price is between or it's 7,500 or more but less than 9,000, the norm price is charged a rate of 8.5%, so as to calculate the mineral royalty tax, right? Then lastly, 10% of the norm value when the price of copper on the London Metal Exchange is 9,000 US dollars or more. So you just have to know how it works. You don't really need to memorize because it's there in the formula sheet. Obviously, maybe in the formula sheet there's a bit of changes, but just know how this works. So now for other metals, which is not frequently examined, but this is also provided in the formula sheet. So it's 8% of the known value for cobalt, 5% of the known value for base metals, 5% of known value of energy and industrial minerals, you know. Energy minerals maybe includes oil, but we don't have oil in Zambia, so most of this stuff is not really as applicable. Then 5% of gemstones, emeralds, then 5% of precious metals. Precious metals can be gold is one of them. All right, but these you just have to memorize. I'll reiterate. You just have to know how it works. So the most important thing here is knowing what the norm value is. So now, what is the norm value? So the norm value is the monthly average metal exchange, or rather monthly average London Metal Exchange cash price per metric ton multiplied by the quantity of the metal or recoverable metal sold. So there are basically three, right? But for theory's sake, I just had to put two. But in the exam, what's the most used um, norm value is number one, this one, right? The monthly average London Metal Exchange cash price per metric ton, right? So the cash price per metric ton, right? If it's 4,500, if it's 6,500, you multiply by the quantity of the metal, right? So if we're selling maybe 1 million metric tons of copper, then the norm value is 4,500, right? The product between the two, 4,500 multiplied by 1, but 1 million is an exaggeration. So let's just say 10,000, right? 10,000 metric tons multiplied by 4,500, which is the London Metal Exchange cash price of the metal. When you multiply those two, then you're going to get the norm value. So norm value is basically the price on the London Metal Exchange times the quantity that's been sold. Then you're going to have the norm value. Then now, the mineral royalty is charged on the rate depending on what the price, the cash price of the metal, right? So we charge, on the norm value. So you multiply the price times the quantity, then you multiply by this percentage, which is based on the norm price, right, on the London Metal Exchange. I don't, commercial break just a bit, but it's really sad, eh? So can't we sell our metals elsewhere apart from London Metal Exchange? Like we develop our own, maybe Africa Metal Exchange in South Africa, so that we should be selling our metals in South Africa.
Yeah, it's quite difficult because of our police and these our colonial masters.
Yeah, you
So
see,
they determine even the price for us. They determine how much we should sell to them.
you see.
Actually, they are the ones that buys.
Mm. Yeah, anyway,
Yeah.
you know. Okay, anyway, so let's look at the due dates, right? So mineral royalty should be paid within 14 days after the end of the month in which the sale took place. So if we sell the minerals in the month of July, then 14 days in the month of August, um, the minority should be paid. Then the penalties and interest for late payment. So penalty of 5% per month or part thereof is paid, right? So if you pay late, 5% of that amount is supposed to be paid, is what is paid as tax. Then as rather penalty, then plus the interest at the Bank of Zambia discount rate plus 2%, right? So these two, so interest, so this is per annum, right? The interest on the Bank of Zambia discount rate plus 2% on the overdue tax per annum, right? Then plus the 5% on the tax overdue, right? Then minority returns are due within 14 days after the end of the month. So minority returns are due. So you have to file in the returns within 14 days, right? If you delay filing in, you pay 300 kwacha. If you're an individual, then you pay 600 kwacha if you're a company. So now the exam approach is this. So when you're dealing with minority tax, so step one, you need to determine the norm value. Obviously, you multiply the dollar price on the London Metal Exchange, then you multiply by the quantity, right? Then step two, after you find the norm value, you need to compute the minority. How do you do that? You multiply the rate, the minority rate, which is dependent on the price, right? The price per ton on the metal exchange. If it's 4,500 or less, 5.5, right? So just a minute. Okay, yeah. So you multiply the rate times the norm value. Then after, then you convert to kwacha with the exchange rate that you're given. I don't know if you have any questions so far.
No questions.
Okay, so now how do we compute taxable profit for mining companies? So that one we're looking at is just mineral royalty, where a company is what selling minerals outside the company, outside the country, or maybe just trading minerals within Zambia. But now, how do we calculate or how do we compute the taxable profit? Right? Just the way we do in the sole proprietorship, the way we do it in the um, partnership, and then an ordinary company, even in the mining company, is just the same. Everything is the same, but there's just a few differences. So one, the first thing is mineral tax is not deductible when arriving at the taxable profit. So when you have the net profit, you need to add back the mineral royalty tax. So sometimes you're given a mining company, then you're told to calculate the mineral royalty tax. That mineral royalty tax that you calculate, you need to add it back. Sometimes you're given the minority tax that was paid, you need to add it back, right? Sometimes it's included in revenue, right? You need to add it back, right? Then taxable profit is calculated in a similar way as for any other business. I know you remember this capital allowances, the depreciations, the accommodation charge for directors and all these other expenses that are just the same. There's nothing that's different. So now there's a few other items that you need to adjust for. Like one, the capital expenditure. So a rate of 20% wear and tear on all capital expenditure incurred for mining purposes is given so long as the expenditure has not been written off elsewhere. So 20%, right? Maybe you buy any other item, maybe a machinery for mining purposes. You buy uh, any item that's relating to mining or mining purposes. It's for mining purposes. We charge a rate of 20%. Then normal rates of 20% and 25% apply on implement, plant, and machinery, right? So here you have to think of the capital expenditure. So any other capital expenditure, but sometimes or most of the times you're given the normal capital expenditure, which is 25% and 20% as appropriate, right? Then now, there's just what we call indexation of capital allowances. So when a company is keeping its books in US dollars, it needs to index its capital allowances, right? So that it recovers, right? So now, if it's keeping it in dollars, but it's keeping the books in dollars, you have to use this formula. So it's 1 plus R2 minus R1 over R1 times capital allowances. So the capital allowances, the total capital allowances that you calculate, then you multiply by this factor, right? Then you're going to get the capital allowance that you're supposed to charge to the uh, that's what you're supposed to deduct from the adjusted taxable profit. So what is R1? R1 is the average mid-rate in the year before capital allowances are claimed. Then R2 is the average BOZ mid-rate in the year capital allowances are incurred. So this, you just have to memorize it when you just see um, the items or the elements, you can be able to just index fast, and then you get the marks. Then you've got adjustments of profits relating to expenditure in mining township. So sometimes, I'll give you an example. I was on a survey. I went to Lufwanyama, right? There's Kejam mining. There's Kejam mining. There's also Harry Calaba's mine and Bushiri. I've forgotten the name. I don't know if it's I've forgotten the name, but yeah. So in Lufwanyama, that's where there's these big emerald mines, right? So Keja mine has built a school. I think about two schools. Yeah, they built two schools somewhere there in Lufwanyama. But now the road that the miners or the employees in the mine use from Kalurushi to the mine itself, it's pathetic, I'm telling you. It's dust road, and these heavy machineries, these big vehicles, they pass there every day. So now there's grass and plants just along the road, and all of them are brown due to the dust that rises when vehicles are passing. Right. So now, if Keja Mine constructs a road in that particular Lufwanyama, Kalushi Lufwanyama road, they're going to be given capital allowances of 20%. So this is what I'm trying to walk to. So 20% capital allowance is given on expenditure incurred to provide services to mining townships. So one, construction or rehabilitation of roads, then two, street light systems, then three, construction of schools, then four, construction of hospitals. So all these benefits that are provided to communities, these companies, they get a capital loss of 20%. Okay. Then now, what if there's a mining loss? So mining loss can be relieved on future taxable profit. The amount carried forward is carried forward for 10 years. So, but it's limited to 50%. So if there's a loss in this year, maybe a loss of 1 million, or let me say last year there was a loss of 1 million, then this year it's supposed to be relieved, or rather it's supposed to be deducted from the taxable profit, right? But it's only 50% of that amount, 50% of the loss, right? Only rather, if the loss is only 50% of the year's income, to prevent creative accounting. That's why they do this. So now, the loss that's supposed to be relieved or it's supposed to be deducted from the taxable profit is only 50% of the year's revenue, right? So if you have that loss, you need to index it as well. You use this formula 1 plus R2 minus R1 times Z loss, then over R1. Then you're going to have the loss that you're supposed to charge to the that is supposed to charge to the taxable profit, or rather the adjusted taxable profit. Then the same applies. R1 is the average mid rate in the year before capital allowances claimed. R2 is the average Bank of Zambia mid rate in the year capital allowances is being claimed, right? Then also look at hedging. So what is hedging? So hedging is just protecting an entity against unfavorable conditions. So sometimes I give an example of interest rates. So interest rates that they fluctuate, they're volatile. So today the interest rate can be maybe 10%. Maybe we want to obtain a loan 3 months from now. The loan at that time the interest rate is going to be 15%. So now how do we lock in the current 10%? So that it applies in the future. This is where hedging comes place. We can buy or sell derivatives, right? So that in the future, when we buy or sell derivatives, the profit or loss that is made from that sale offsets the risk. It locks in the current interest rate, right? So now, hedging income is taxed separately from mining companies. Then hedging losses are offset against future hedging income. So this is just something that you need to know. It's for knowledge's sake, but I've never seen a question relating to hedging. Then income tax is 30%. So for mining companies, it's 30%. Just to be sure, check the formula sheet. Maybe they might have changed, they might have given an incentive of 25% this year, but just make sure you check the formula sheet. But for now, we can work with this 30%. So now, there's sometimes where a Zambian resident or a company in Zambia that's resident in Zambia receives foreign income. So, for instance, you, Mr. Isaac, you've invested in a company in South Africa, all right? Then you receive dividends from South Africa to here. So that amount is supposed to be liable to taxation because you're a resident, a person in Zambia. So now, a person resident or ordinary resident in Zambia is liable for taxation on foreign income received. So foreign income is charged on the actual received basis, right? So foreign income is only chargeable when you receive it. It comes into your bank account, then you need to pay tax on that amount, which is obviously withholding tax if it's dividends, right? So all foreign income is liable to Zambian taxation unless it is exempt. So for instance, rental income is exempt, so no taxes paid. All right. Then tax already paid is deductible at gross. All right. Yes. So if there's already tax paid, we need to make sure we recognize the amount, the total amount at gross, then we deduct that particular tax in the Zambian context. Okay. So now, foreign income for companies and individuals. So these are just examples of a foreign income that can be received. So then we want dividends, there's rent, there's interest, there's employment income, then there's profits from business, right? And also share of profit from partnerships. So dividends, they're taxable. So foreign income relating to dividends, these are taxable. Then rent is not taxable. Interest, interest on the bank loan, you issue a loan to somebody, a friend in South Africa who has a company, maybe a 1 million, then they're paying you 200,000 per annum, right? All right, right? That 200,000 is what liable for taxation. Then employment income, you were employed in South Africa, then you've come back to Zambia. Then now they've sent the benefits and emoluments and all those amounts that you worked for in South Africa or any other country. Those are taxable for tax purposes. Or a person is coming to work in Zambia, right? Maybe a director, ABSA's, not ABSA, but let me just say Cobalt Mine, right? Has employed a CEO from America. They brought them to Zambia, right? Then they've given them benefits. So as long as that person is ordinary resident in Zambia, those incomes that are received via income, they are via employment income, they're chargeable for tax purposes, right? Then profits from businesses outside Zambia, for instance, Trade Kings has got a subsidiary in Malawi. Easy Noodles, Easy Noodles sells its products in Malawi, right? Then the money comes to them, all right? That amount that they receive is chargeable for taxation. Then proportion of partnerships, if you've got a partner in Zimbabwe, then you run a business together. So all the profits that are going to result from that operation is chargeable it's chargeable for tax, specifically limited to your proportion of ownership in that particular partnership. So this is something, because I've seen some questions, even that question that we're covering that day on customs and excess duty. The first question, part A, it covers this. So you can take a look at it. So now, non-resident income. So non-resident persons who earn an income in Zambia are liable to taxation. So if a non-resident person comes into Zambia, maybe they just come here for a tourist, they come here for 3 months, then they start a loan business, right? They need to pay tax. Then foreign income earned by a non-resident is not liable to Zambian tax. So if a non-resident person receives tax, or rather they receive foreign income, they receive dividends on these other issues, those are not taxable for tax purposes. I don't know if you have a question so far. Hello?
Yes, Mr. Patrick.
I don't know if you have a question.
No.
Okay. So now, there's sometimes where there's double taxation, right? Where you, Mr. Isaac, you receive income in form of dividends. So remember, withholding tax is charged at source, right? So there in South Africa, where you have an investment, that amount of taxation is, or rather, that dividend is liable to withholding tax, right? Then even in Zambia here, since foreign income is liable to withholding tax, right? It's also supposed to be taxed. But now there's that issue of double taxation, right? The amount is taxed in South Africa, then it's also taxed in Zambia. There's that double taxation. So there's three main ways that you can offset that double taxation, or you can give a double taxation relief. So one, there's treaty relief. So this is given when the president of Zambia, Mr. Hakainde Hichilema, and the foreign country have signed an agreement on how tax would be apportioned. So South Africa and Zambia, they agree saying, okay, if Zambians or South Africans are receiving dividends, let's say who's going to be charging the tax. Is it South Africa? Is it Zambia? Or it should be Zambia. But at the end of the day, the tax that is yielded from the transfer of dividends or interest or other foreign income is what apportioned between the two. That's a treaty relief. So there's an agreement between the government of Zambia and any other foreign country on how the tax is going to be administered. But now, in most cases, the president of Zambia can't have a treaty with anybody or everybody. There are certain countries in which, for example, Bahamas, you're receiving dividends from Bahamas for a hotel that you've invested in. I don't even know if we've got a Bahamas embassy in Zambia. We don't, right? But now, so obviously there's no treaty agreement there. So now, what do we do there? Then this is where this unilateral relief comes in. So unilateral relief happens where there's no treaty. It's applied where there's no treaty between the president and any other foreign country. So Zambian tax is charged on the foreign income, limited to the maximum of the Zambian tax on the foreign income. So we charge Zambian tax on that foreign income, you know, right? So it was already charged um, at source, but we charge the Zambian income or income tax. But that amount of income tax is supposed to be limited to the Zambian tax. So it's not supposed to be more than the Zambian tax. So it's basically tax charged is the lower of the amount of tax paid in the foreign country and the Zambian tax chargeable on the foreign income calculated using the formula below. So we need to calculate the effective taxation, right? So we calculate the effective taxation. This is more of a notion of taxation, or rather, we need to calculate the taxation applicable to the amount of dividends or other foreign income. So it's basically it's the effective tax. So you gross amount of the foreign income, right? So that's the total income that has been received, right? The total income that has been received, then over total income assessed. So for now, it doesn't really make sense as much, right? But let me just try to explain what happens. So what usually happens when you're calculating this particular tax, right? The foreign income that's received, you first uh, find the gross amount, right? When you find the gross amount of the foreign income, then you charge tax, income tax. For an individual, you charge income tax, right? So now, after that income, you adjust it, that becomes the total amount of taxes supposed to be assessed, the gross amount of the income, right? Then now, so if you've got maybe two incomes, rent and rent and dividends, you find the gross and you find the total. Then that's the amount of tax that's supposed to be assessed. Then now you get the gross of the dividends. So the gross amount of the dividends, then you divide by the total amount of the income that's going to be received, right? Then you multiply by the tax charge that's supposed to be paid, right?
Yes.
And then that's the amount of withholding tax that's supposed to be uh, assessed, but that's supposed to be applied for example purposes. But now that amount that you find, you need to compare it with the actual tax paid, right? The lower of that amount of tax that's paid in the foreign country and that amount of tax that's paid in Zambia, then the result is what you deduct from the tax already paid. Then the third double taxation relief is unilateral expense relief. So the foreign income is tax paid is deducted from the gross amount of the income as if it were an expense. The Zambian tax rate is charged to the net amount of the foreign income, and the foreign tax paid is deducted when calculating income tax. So this is just theory that you need to memorize. In case they ask you, what are the three major ways of double taxation relief? There's one, treaty relief, then unilateral relief, which is unilateral credit relief, then there's unilateral expense relief. So the foreign income for unilateral expense relief, the foreign income tax paid is deducted from the gross amount of income as if it were an expense. So you just deduct it as if it were an expense. Then the Zambian tax is charged on the net income of the net income on the net income. That's what you charge Zambian tax on. Then that tax that you calculate, you deduct the tax already paid. Yeah, with that said, our lesson has come to an end.
Okay.
Yeah. So